Okay, hello, welcome to the channel. Today we're covering Snap-on stock with a discounted cash flow valuation using their Q4 2023 financials. And we're going to see, is this a good stock to invest in? What is the expected return at the current price? And if we want certain returns, what price should we pay for Snap-on? A lot of value investors have been talking about it recently, but we're going to see exactly what's going on with this company. So to start out with, a little bit of background on what Snap-on does and what their company entails. They design, manufacture, and produce high-end tools for professionals who work in automotive, aviation, construction equipment. So you're talking about techs, diesel techs, and people who work on cars, work on heavy equipment, even down to manufacturing, oil and gas industry. So anyone who's a technician working on those big engines, they use tools, very specific tools, and but some of the most basic tools, but they're very high quality, high end for professional use, even down to your ratchets and wrenches and all that typical stuff. Snap-on has their own major brand tools, but they also own lots of these subsidiaries, these other companies, in their brands portfolio. Lots of them are tool companies, lift companies, or companies in that realm that deal with automotive repair, etc. So let's take a look at the price history of Snap-on stock, ticker symbol SNA, by the way. We can see that they have a long-term growing trend. Obviously, right now they're actually quite high compared to their historic trend, but that doesn't mean that they're necessarily overvalued. They could still be undervalued. It's depending on their fundamentals. It's depending on their earnings history. We're going to see that in a couple slides, but I just want to point out that back a few years ago, they traded flat for quite a while after a long extended 4-year run of almost, like, you see how consistent that price chart is right there, that growing without going wildly down or up like we saw after that period. So after very consistent fundamentals growth and just the price ever presently growing upward, then we hit this period where it's like investors were not sure. They were trading up, they were trading down, down, up, but it was staying flat for a while. Then we had the pandemic, and out of the pandemic, a huge surge, which we've kind of seen the continuation of. But if you look back long time ago, long term, you can see the growing trend of the company. And what's really interesting that we're going to see in a couple slides is the dividend chart of this company. For a company that you can see successes, you can see they had an extended period where they didn't see any gains, you'd think that the dividend would be paused or that they would have trouble with their dividend. But no, when you see that dividend trend, it's long-term growing dividends and they continue to increase it. So this is one of those potential dividend aristocrats in the future, but it matches with this long-term price trend with a really high R-squared, which means overall, despite some of these large declines and surges, over the long term, it fits a growing trend fairly accurately. Now, this is their revenue. If you're looking at that price chart and saying, oh man, during COVID, it went way down or huge price surges, but the price surge is not matching to their revenue. Look how steady this slowly growing revenue is. And I say slow because over the 10-year period, it's an annualized 4% per year growth. It's grown a little bit faster over the last 5 and 3 years because of coming out of this dip during the pandemic. But you take that little dip out and wow, it's got a little bit of cyclicality where it gets a little flat and goes up a little bit, gets a little flat, goes up a little bit. But come on, look at this thing overall long term. I mean, that's as steady as it comes when it comes to revenue growth. So let's go ahead and look at the profit based on that. And what do you know? It's so consistent. Take out this pandemic dip. Is that not the most consistently growing, steady profit you've ever seen in your life? I mean, this company is the definition of steady because they have really one set of products. And their customer base isn't growing wildly or rapidly. They're not going into huge recessions or anything. They're people who work on cars. They're people who work on engines. This type of business is very steady. It's very consistent because people are driving. They're still driving around, putting miles on their cars. They need their cars fixed. Those trucks are still driving, bringing goods across the country. It's a growing business, and you can see that 11% growth per year over the last 10 years. But it's not a business that goes wildly up and then wildly down. So very steady growth in the type of business that they're selling to, and they have pricing power because they have a big brand and people really trust their tools. They're made in the United States. I'm pretty sure they have factories even in the US, so employ a lot of workers, and they just have that made in America type brand, and it's very reliable. It's not cheap tools. They're reliable tools that last a long time. So you have a consumer base that's always going to come back to you. You can price your tools a little bit higher and people keep coming back and buying them. Let's see how that's translated into free cash flow, because sometimes when you have net income that's consistent high, well, free cash flow not necessarily, because it may be a capital intensive business, and free cash flow is really that cash from operations minus capital expenditures. So because they make their own tools here, yeah, there's going to be some times where they need to invest in capital, plant, and equipment, because they have their own factories and they're going to invest that money. You can see times where their free cash flow on a rolling 12-month has declined, then surged up, then it declined a lot, because their profit may have flattened and it wasn't going super far down, but at the same time, they were investing capital to restore their factories, make sure everything was up to good quality. So you're going to have cycles where you invest into your company, and that's going to draw down your free cash flow. But right now, ever since the end of 2022, this past year has seen a surge back up. They've paused some of those capital expenditures or cut back down on them, and their free cash flow has really gone up. Their cash from operations has continued to climb. So that's a powerful trend in the upward direction. And so what you get is a 10-year growth rate of 12% per year. That's based on this final data point. So we can look at different points along this thing and put a linear line through and say, oh, maybe it's 12%, maybe it's over the long term, maybe it's closer to 10% or 9%, somewhere around there. So that's going to be crucial when we look at our projection into the future, what we think this company is going to do in the next 5 years, in the next 20 years. But next, we just want to look at shares outstanding and show that in different periods, they've bought back shares. They're not heavy on share repurchases. Right now, they've stayed fairly consistent over the last few quarters. Really, when the stock price to the management is undervalued, they buy back shares, and I think that's awesome. So over the long term, they've decreased a little bit. That's less, just under 1% per year for the last 10 years. But you can count on them if their share price goes way down. You can count on management to enter that buyback phase, but they're not going to go overboard with buybacks. The question is, do they have a plan for deploying capital when they have free cash flow? Instead of buying back shares, what are they doing with the money? Well, we know they're paying dividends, and we know the other question is, can they redeploy the rest of that capital to grow the company, to make the company even more profitable in the future? So we'll look at return on invested capital in a second, but I want to show the per share profit and free cash flow. You can see the net income per share in pink, and the green is the free cash flow trailing 12 months per share. So this is taking what we looked at earlier and adding in the fact that their share count has decreased slightly over time. And here I put these red shaded areas under the curves to show that when you're looking at free cash flow, net income, what I was talking about earlier is when their net income was still increasing slowly, their free cash flow increased a lot because they cut back on capital expenditures. But then in the next 2 to 3 years, that means they needed to spend more on capital expenditures then. So when you have a period where capital expenditures are high and your free cash flow is drawn down, you can expect it to go back to return to the mean, which is their net income, and now they're exceeding, and they're going to have a period where they're going to be exceeding net income when it comes to free cash flow. Over time, you want to think of the line, smooth the line to a more flat state, because you can count on the management to make the capital expenditures in a reliable manner, and you can see the long-term trend is growing very steadily, that capital expenditures aren't killing the company. And so that's a good thing to know. And then when it comes to these cycles, you can just be prepared and think ahead. Free cash flow per share, earnings per share, 10-year annualized rate of growth of 15% for free cash flow, 9% for earnings per share. So that's important going forward. Here's that return on invested capital. We can see that they've consistently stayed above 10% for a company that deals in a physical product where they have to manufacture it and distribute it. That anything above 10% is great. We usually say if it's a tech company or something with really high margins overall, we want to see above 20%. That shows us that that's a company that even in the tech space knows what they're doing. But you're seeing Snap-on getting returns on invested capital above 20% over the last 10 years or so consistently. So they dipped down a little bit here, but so to me, this is a sign of a great company. They know how to take their free cash flow, reinvest it, and grow that company. And so even though they're paying some in dividends, we know that the company is going to continue to grow. It might beg the question, why are they paying dividends? But here's why they're paying dividends, because they're really good at it. They have been so consistent at growing the dividends each year. This is their total dividends paid, not per share, but total. But you can see that that line is consistently, so consistent. So this is a dividend aristocrat contender. In 20 years, they're going to be like, you need this company in your dividend portfolio if the company continues to do well and continues to be that well-recognized brand. And this value right here, the growth over the last 3 years, 5 years, and 10 years is very identical, around 15% per year increases in their dividend. So when it comes to forecasting into the future, that's something that I like to look at a lot, because when the management decides to increase the dividend, you know that they're taking into the account long-term prospects and what they know about the long-term of the company. They're not going to grow the dividend significantly higher than they think the company will grow in the future, unless they're in that dividend ramping up stage. But for a mature company, I think this is key. The fact that their dividend growth rate over a long period of time has been so high is going to be significant when we go to project their future free cash flow. And we're going to see what analysts say, but keep your mind on this metric right here, these 15% per year over a long period of time. Taking a look at their balance sheet, we see that they have $960 million in cash on hand, and that's to mirror their $980 million about current liabilities. So we can see their current assets balance out their current liabilities. They do have a bit of long-term debt, about $1.5 billion, but look at their total assets at $7.3 billion. So when you have $7.3 billion in assets to $2.5 billion in liabilities, that is a great balance sheet. And especially when your cash on hand is enough to pay off pretty much all of your current liabilities, and it's more than half of your total long-term liabilities, and it's more than a third of all your liabilities combined. That's a great cash position. The company has free cash flow. The assets are humongous because, again, they have property, plant, and equipment. They have their brand value of intangibles. So for their book value of $4.9 billion, we reduce it and take into account these adjustments just to be on the conservative side when we're estimating their adjusted book value or safe conservative book value of about $4 billion, $3.8 billion. So per share, that's going to account for $71, almost $72 per share. And the company's trading at $275 per share. So the rest of that value would have to be made up by their free cash flow, all in the future, discounted to present day. So we're going to take a look at what that is in our DCF model slide. But first, I want to look at the business pillars and show that this company checks off all my business pillars almost. On a couple occasions, it had 3 instead of 4 out of the last 5 years. And so to me, when you get 2 metrics like that, they're so close, I just change that to 20, give them the benefit of the doubt, say they're almost perfect here. Their debt, their shares outstanding, their free cash flow, return on invested capital, their dividend is under control. It's less than half of their free cash flow over the last year. And their price to earnings ratio, their valuation metrics are good on free cash flow and on earnings. So there's something happening here. Is like, wow, it's checking off everything. It's extremely fundamentally sound. We saw the consistency of their revenue and earnings. This is one of the best fundamental companies that you can find. It's one of the best. The dividend consistency speaks to that majorly. It's a sustainable company. It has a big brand. It's an entrenched business. It's well run. I love everything about that. But we're going to see what is the price right now, and does it justify the free cash flow? So a lot of times when you see companies that are this steady, they get priced really high in the market because it's a premium to have a company that's that steady, that you can really count on. A lot of people will throw this in their dividend portfolio, in their retirement portfolio. It's so projectable, it's so steady, so confident in it, I'm going to pay a premium for it. So where does it get bid up to? Well, let's see. So on this slide, I'm showing for my valuation, my mid-range assessment, what are the assumptions that I use here? Now, if you remember, the free cash flow for Snap-on in the last year was over $1.2 billion. But we saw that there was some cyclicality, some fluctuation there. And I'm just going to be a little bit conservative below that and say, let's use a base year free cash flow of $850 million. And if you look at the chart, you can see that that's right about between where they were at their low point and where they are now. And they might be peaking, right? So $850 million as the base year. And we're going to grow the company over the next 5 years at 8% per year. Now, the analysts were saying something like 3 to 5% in earnings growth over the next 5 years. But when I look at the dividend increases that they're posting, I don't understand why the analysts are so pessimistic and so modest on Snap-on. I mean, Snap-on has proven that they have pricing power. They've proven that they have a consumer base that's so steady. Why not say 8%? Because they've been growing at 12% to 15%, depending on the metric you look at. So over the next 5 years, especially if we set the base lower than what they really are now, and maybe that's why the discrepancy, because they're projecting from the current 1.2 billion in free cash flow or earnings, and I'm going to be projecting from something a little bit more realistic or conservative. So to me, the 8% is very justified. It's almost on the conservative side. But then I'm going to do over 15 years, I'm going to set that 4% per year growth and then put it as a perpetual growth rate of 2%. The company will be around for a long time. It'll just be growing very slowly. Margin of safety of 20%. We could have even gone 15%. The fundamentals are so sound, but I don't like to get into that range. If at all possible, I'll stay in the 20%. And to me, that's just a sign that it's very predictable. I'm not discounting it by that much. Usually I discount companies by 30% or more. So 20% is going to be the margin of safety. And with all of those assumptions, the discount rate that balances the current price today with all of the future free cash flow plus their current booked value, the balancing discount rate is 13%. And so that is my expected return going forward if you own the company at this price. And so you can see at each of these discount rates, 5%, 10%, 15, 20, here's the price per share I'd be willing to pay under the discount rate assumptions given there. So right now the price is $275. So it's somewhere there between 10 and 15%. If I wanted a 10% return, I should be willing to pay $345 a share for Snap-on. So for a good quality company, you could say 13% return is not bad, but let's take a look at a lower, more pessimistic outlook of the company. Let's go ahead and assume a base year free cash flow of 800 million instead of 850. Not a big difference, but the growth assumptions are going to be different. 5% for the next 5 years, 3% for the 15 years after that, and a 1% perpetual growth rate. A lot more modest growth going forward for the company. And we're going to use a margin of safety of 25% instead of 20, just for a little bit extra comfort. And that's going to be closer to a typical margin of safety I use. Maybe it can represent the decent sized debt that they have, even though we show that they have cash to cover and free cash flow for sure. But they have had a little bit of fluctuating free cash flow recently, so that might cover part of that as well. And when I use all those assumptions, I get a balancing discount rate of 9%. So the expected return there, 9% in the pessimistic scenario. And again, at 10%, we're just below the current price. If you want to get a 10% return, then under those assumptions, you'd pay $255 a share. And right now it's at $275. So it's very close, but a little bit under. So again, 9% would be the balancing discount rate. So what do I have to say about all of that? The main point is that I don't agree with these analysts who are projecting 4%, 3%. The next 5 years. I mean, to me, that's ridiculous. I mean, Snap-on is going to continue to grow. They've done that for so long. Why would you say it's going to be different right now? I mean, yeah, of course, anytime we can go into a recession, but if you're just projecting a normal economy and you're an analyst, why wouldn't you say 8%, 10% even? So I'm closer to something like that. Like free cash flow will probably grow closer to 10% per year. So therefore, I'm thinking that this is going to be about a 15% expected return. Again, I showed, I think 13%, 15%, depends on your assumptions that you use. But if I'm being friendly to Snap-on, and I really want to be friendly to it, right? Because the fundamentals are so sound, a 15% expected return, that's pretty good. And for one of the most reliable, stable, predictable companies, that's hard to beat. So when we cover companies, if you want to add quality to your portfolio and you're okay not getting a 50% return, like super high returns, you're okay getting like basic returns that slightly beat the market, I think Snap-on's a good option to add to your portfolio. I mean, I'm not going to give you specific investing advice. You have to do the research yourself, of course, but it depends on your goals again. And if your goal is add quality and get a decent return, I would look at Snap-on if I were you. I would own it as long as it stays under $400 a share, because it could be a 10% return or 10% discount rate equivalent, all the way up until $400 a share. And then, I would start to sell it. But its quality is just like something you keep in your portfolio until it gets really high. And of course, that'll update as new financials come out in the future. And I would put it, if I had a dividend portfolio where I wanted stable growth, that kind of portfolio, I would add Snap-on to something like that. My overall value rating is 8 out of 10. And that's the 30th highest out of Valuated out of 311 companies. So it's in the top 10 percentile, top 30 companies there. Again, the expected return isn't going to blow you away, but for the stability and the fundamentals, it's something you might be willing to trade off. So that's the breakdown of Snap-on stock. Hopefully you guys enjoyed that. Comment down below, what do you think of Snap-on? Do you own it? And what assumptions would you use differently? And let's go ahead and compute an estimated fair value or discount rate equivalent for your assumptions in the comments section down below. Thanks for joining me. Best of luck investing. I'll see you on the next video.